My love, my friend came to me today and said, "What is your interest on loan?" I did not know what to say other than very interested. That is why I'm looking for loan.
Yes, of course, we are interested in what payment is. I don't understand why they call it P.I.TI. Why is it a P.I.TI, my payment?
I don't understand these acronyms. You know what? We just need help.
Hey, welcome to episode 4 of First Time Home Buying and Selling. I am Josh Madison, residential real estate broker in the state of Arizona. And in this episode, we're going to go over how interest rates affect your monthly payment and what you really end up paying over the life of the loan. We will also cover why bank payments are P.I.TI and what that stands for. So let's get into it. So what is the principal? Well, in loan terms, principal is for the principal loan amount. It's the amount of money you borrowed from someone. Okay, well then what is interest? Well, interest is defined as the amount of money paid for the use of someone else's money. I'll repeat that. It's the amount of money paid for the use of someone else's money. For example, let's use our seller finance or owner carry sale from a previous episode. So you're buying a home directly from the seller for a $100,000 purchase price. You give the seller your own $10,000 cash down payment. The principal balance still owed to the seller is $90,000. The seller wants to be paid off in 10 years. If the payments were for the principal only, then you would owe $9,000 per year for 10 years. So that's a $750 monthly payment. This is where interest comes into the equation. Now remember, interest is the money paid for the use of someone else's money. You are basically borrowing $90,000 from the seller, promising to pay them back over 10 years. So let's say the seller charges you a 6% interest rate for the life of the loan. So basically, you're being charged an additional 6% on top of the $90,000 that you owe per year, or annually, as it's called, an annual percentage rate, or you'll hear it called the APR. So instead of your $750 a month just paying down the principal balance of the $90,000, your monthly payment is now $999.18 over the next 10 years. It's called P.I.TI, standing for principal and interest payment. You can figure your interest payment by taking $90,000 multiplied by 6%, which equals $5,400. Then take the $5,400 and divide it by 12 for 12 months in a year, and you'll come out to $450. $450 is how much is going towards interest out of your $999.18 payment. The remaining $549.18 goes towards paying down the principal balance. Over the 10 years, the interest goes down as the principal balance shrinks. Does that make sense? Yeah, it makes sense, but why does any of this matter? Well, because the better financial education you have, the better you will understand loans and the cost of borrowing money. See, in the example, by the end of the 10 years, you will have paid $29,902.26 in interest alone. So that original purchase price you agreed for $100,000 with $10,000 down of your own cash, you'll end up paying a total of $119,902.26. Believe it or not, that's nothing compared to the traditional bank finance loan I'll show you here next. Using one of the traditional bank finance loans that I spoke about in the previous episode, like a conventional loan, FHA, or VA, we will use the same purchase price numbers of $100,000. We'll even do the $10,000 down at 6% interest, but we'll offer the example the way the banks offer it to you at a very comfortable 30-year term to pay the money back, which sounds great because in that example, your monthly payment is only $539.60. You could buy 2 homes compared to the previous seller finance sale. Take a guess at how much interest you pay the bank if you stretch it out for the full 30-year term. On your original purchase price of $100,000, After the 30-year term, you will have paid an additional $104,251.36. In total principal and interest, you will have paid $194,251.36. That is the exact example of why I stress the idea of coming up with as much cash as you can and clearly knowing the answer to what's your why when it comes to possibly the biggest financial decision of your life. I don't mean to discourage you of home ownership. Real estate has made people rich and helped give them financial independence. But you must go into it with your eyes open by financially educating yourself on the numbers. I have a couple other numbers I want to go over that will affect your payment before we wrap up this episode. Your loan payment is often described as being paid P.I.TI. Well, we know the first P and I now is for principal and interest. Can you guess what T.I. might stand for? Well, pat yourself on the back if you just said taxes and insurance. But if not, no problem. Let me explain why taxes and insurance are added monthly fees on top of your principal and interest payments. Have you ever heard the saying, there are two guarantees in life, death and taxes? Well, there's some truth to that. Every piece of real estate in the United States is assessed a certain amount of real estate taxes every year. In Arizona, the property tax bill comes out twice a year. One bill for the first half of the year and one for the second half. If you don't pay your property taxes, your local county can foreclose on you and take your property. Well, they can't physically remove your property. They just physically remove you from it. Even if you own your home free and clear and you don't owe the bank a penny, you still have to pay your annual property taxes. That's why your home loan payment includes taxes as part of the P.I.TI. payment. Let me give you an example of how it's broken up in your monthly loan payment. Let's say the annual property tax for your home that you're buying is $1,200 a year. Well, there are 12 months in a year, so you would pay an additional $100 a month on top of your payment. So the seller finance example payment of $999.18 of principal and interest is now $1,099.18 when you add the tax payment in. So what's left? Insurance. Now, insurance is not required by law. If you own your home free and clear, you have to pay taxes, but you don't have to pay insurance. It just could be very risky if anything should happen to your home or on your property. Homeowners insurance, also called hazard insurance, was put into place to cover life's little what-ifs and whoopsies. Like, what if a water line breaks while we're not home and floods the entire house, rotting out the floors and walls, with mold ruining our house? Or, wow, look at all those fire trucks on our street as we're getting home. Whoopsie, I think I left the oven on. Hazard insurance is set up and paid for by you to cover these potential losses. Your lender or bank requires that you have insurance in place to cover at least the amount that they loan to you if something should happen. That way, the insurance company can pay them back the money they're owed for the destroyed home. Let's say to cover your home, insurance charges $600 a year, as an example. That's probably low these days, but it'll give us a good round number. So that would be $50 a month on top of your $1,099.18 payment, making your total P.I.TI. payment a month now $1,149.18. So if you decide to get pre-approved for traditional bank financing for your home loan, find out from them how much they will approve you for, the principal, and what interest rate you can expect to receive. You'll then have an idea of what your basic P&I payment will look like. So then when you go look at homes for sale, you can easily look up how much the property taxes are, divide that number by 12, and add that to your potential payment. You can also contact your insurance company for some estimates to insure that home, and then add that in as well. It's well worth it to do your financial education homework before you get sucked into the financial hamster wheel of payments that you can't comfortably afford. In the end, you want a happy home that you love, not an anxiety nest that you have to live as a wage slave to pay for because someone told you it's the American dream. So hopefully by now you should understand interest a little more and why you should care about it. You should also know what a payment made P.I.TI stands for and the basic costs associated with it. In the next episode, I'll keep beating that financial education drum as I break down the loan and sale closing costs. Hey, once again, thanks for joining me in episode 4. I hope you got some good information out of it. As usual, if you have any questions or comments or something you'd like me to cover in a future episode, I left my website in the link below. Until then, I'll be talking to you in the next episode. Thanks.